Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Thursday. You know what that means. We bring back on the man, the myth, the legend, Mr. Jonathan Twanley. How you doing, sir?
I'm doing great. How are you, Michael?
I'm doing very, very well, man. So, first topic of the day is something that I am not great at talking about because I don't really play here, but that's why I have experts like you. So, let's talk about multifamily trends for 2022. And just to be clear, we're talking multifamily, we're talking big units. I don't know, 50, 100, right? The big stuff, not a fourplex.
Yeah.
So, Jonathan, when I talk about 2022, which is only 50 weeks long, we've already blown through the first 2 weeks. Isn't that crazy?
We just blew 2 weeks. I mean,
Yeah, it's gone. The year's over.
Never get it back again. Yeah.
Never get it back.
Yeah.
So when you think about 2022 in large multifamily, what are some of the trends you think about? And we'll play ping pong and bounce around a little bit.
Well, listen, I mean, I see 2022 as being more of the same from 2021, right?
Okay.
In 2021, we saw a lot of money flowing into the asset class, and we saw really a massive amount of rent growth as people as we emerged from COVID, and people felt confident to go out and rent apartments again. And as we've seen, wages have been going up. Workers have a lot more power. They're switching jobs. They're getting raises. And so that's making its way into rents. And so I don't think that we will see the kind of spectacular rent growth that we saw last year, because that was a function of a couple of things. I mean, that was a function of pent up demand, and also a function of the fact that rents had actually declined the previous year. So, had a big bounce back, right? So we're not going to see 17 to 20% rent growth again this year, but, but we will see strong rent growth again. And
so when you say, just so everybody realize, strong rent growth, what is normal rent growth? 3%?
I mean, you underwrite to 3%.
Okay.
We've had stronger rent growth than that over the last few years. And I think some people have gotten more aggressive with that assumption of rent growth.
Okay.
I personally wouldn't do that, but I know that there are people who have changed their underwriting because of, I mean, it's not like a complete, ridiculous. They're not pulling the number out of thin air. There has been strong growth in the last 10 years. But you're not going to see, if you underwrite 17% rent growth, you're an idiot. I mean, unless you're forcing it, right? If the rent on this unit is 17% below what everybody else is getting for the same unit, you can write that in your first year rent growth because you're going to get it because you're going to raise rents. That's not what I'm talking about. I'm talking about natural rent appreciation, which I think will still be strong this year because there's still just a lot of pent up demand. And, as we're talking about, I think in another session today, home sales are down, and that a lot of that's a function of not being able to buy homes. The inventory is very low. So people are going into, apartments now, and who knows, this is just speculation on my part, but if they kind of had their heart set on a home, right, then they may be willing to spend more on an apartment than they otherwise would have, because they're already mentally made this switch, I'm going to go live someplace nice I really like, I'm going to buy it, and then they can't, and they're like, okay, well, I'm going to spend another $100 or $200 a month on rent to get a nicer place. I think you might be seeing some of that too. But there's definitely just a huge amount of demand. So I see cap rates continuing to be compressed in the asset class. I see rent growth continuing to be strong. I see a lot of attention continuing to be put into the sector by investors of all stripes. I don't really see any of that changing unless the Fed raises rates enough that it starts to change the calculation, either by pushing up interest rates to the end user, which will have an effect, or in terms of making other things more attractive, right? If your risk-free rate of return goes up, then some money is going to get sucked out into the risk-free, assets, i.e. bonds, right? So that will have some effect, but I don't think it will have a major effect. I think you might see some softening around the edges.
At the edges, yeah.
But I I mean, of course, no one ever sees the calamitous thing coming, right? So I don't see the calamitous thing coming. But I don't see, there's nothing really on the horizon that, to me, that says that the sector is in danger in any way of a correction. As much as I would like to see a correction, because I like to buy,
You like to buy lower, right?
I like to buy lower and really make money, but
Yeah.
you know, but I don't see that happening anytime soon. So I think if you are buying assets, you know, you have to be thinking about the downside. I mean, I think the market is too, cap rates are too compressed. It's too hot to be thinking really sort of in terms of upside, how much upside you're going to make. I think you need to be thinking about protecting yourself about when that correction does happen. I mean, it is going to happen at some point. We don't know when. Maybe not in the next 12 months, but I think if you're buying an asset and intending to hold it for 5 years, you have a very good chance of seeing some kind of correction. So you have to make sure that your asset's going to survive it, and that's how you should be underwriting. So thinking a lot about how bad do things have to get before I should need to be worried about this asset. And if you feel comfortable with that answer, then go ahead and buy, right? But if you feel a little bit like, you know, then maybe you're contemplating overpaying. So
yeah, so let me kind of summarize what I heard you say. And of course, correct me if I misspeak. So first off, rent growth above trend again, not the exorbitant 17%, which was reported by apartments.com, but certainly above 3, probably above 6. So another rent growth, and that makes sense to me. My 30 years of doing this, or 25 years or whatever it's been now, rents follow values, and we've seen values run ahead, and rents are always 9 to 12 months behind. So I think, just naturally speaking, I think rents go up more from here.
Yeah, and look, I mean, unemployment is down to where it was before.
Oh yeah,
right. So the economy is cranking in spite of the, you know, the fear mongering around everything, around, you know, coronavirus, around inflation, around all these other things that there's all this fear mongering about. The facts on the ground are that the economy is cranking, right? So that leads to rent growth, and that leads to demand for apartments, right? So
absolutely. The other thing on demand that I think a lot of people are missing, and I actually got this in an article about Manhattan, but what I'm about to say, I think plays in a lot of rich areas. So a lot of people that lived in Manhattan left, and they bought places in Florida. But what this article is talking about, one of the reasons that Manhattan's vacancy now is 1.7%, where last year it was 11, is yes, some people left, they sold their pad, they left, but now they're coming back and they're wanting to rent a unit because they don't want to leave New York forever, right? They still have offices there, relationships there, all of that. So now you're this millionaire down in, you know, on the water in Florida, but you're increased demand in rentals because you're going to want a pad that you're at, I don't know, a month, a year. And again, if you're the 1%, you know, you can do that, but still, that's still more demand. And I think that plays in California. I live in the Bay Area. A lot of you moved to Tahoe, Reno, Vegas. You know what? Maybe instead of having a big house in Palo Alto, you know, you're going to rent someplace in Mountain View. And I think there's just increased demand coming from people who left as renters.
Yeah. And listen, I think a lot of the people who quote unquote left, right, didn't actually leave. They actually already had a second home somewhere and went there and wrote it out, or they bought one. And I mean, this is just anecdotal, so you can't, this is not like data, but it is evidence, right? That over the past few months, or I guess before, you know, it got cold out, every time I went to like a barbecue or something in our neighborhood, literally every single person there had bought a COVID house outside the city, right? They didn't move out of the city, but they had everyone had bought like something upstate as like a place to, you know, and probably everyone been thinking about it for a while, but they never wanted to pull the trigger. And then finally they're like, you know what, we need to buy something upstate. And so it's just remarkable, like how many more people now have second homes. And of course, that's obviously people who can afford second homes, but that puts pressure on everything else. I mean, one of the, you know, puts pressure on affordability, puts pressure on, you know, supply, puts pressure on everything. So, but then a lot of those people, I think you probably have a number of renters too, who did just that, who they were renting.
Yeah. Then they,
right. Then they bought someplace outside, or they rented someplace. A lot of people do long-term, like really long-term rentals too. They left, they went, you know, they did their remote schooling with their kids from, you know, farmland upstate someplace. And then now they came back. Schools reopened, and they're like, okay, we've got to rent again now. Now they're back. They're all back in renting.
Yeah.
So,
right. So the next thing, again, cap rates are going to stay compressed for the year. I think that makes sense.
yeah.
You can't, they can't, I mean, when you push on a spring, right, there is this level that can't go much lower. I think we're really at or near that. So I like your idea. Don't assume you're going to go from 3.5 to 2.5. I've actually heard people say that cap rates are going to go to like 2.5. I'm like, wow.
Well, someone said that in my Facebook group, but it doesn't make any sense. If you have cap rates going below the interest rate, you will have negative leverage, and that means you're actually for every dollar that you borrow, you're making less money on your equity rather than more.
Yeah.
So now, if you had a true hyperinflative environment, maybe that would make sense, because the idea of you losing less money that way than you would be just by sitting on money. But of course, like if you had, you're also going to talk about, if you had hyperinflation, you're probably talking about 15%, 20% interest rates.
Yes.
Right. So that's going to have a whole different effect.
Different impact. Yeah.
Forecast. But yeah, I just don't see cap rates going below interest rates.
Yeah.
And interest rates are going down. Right. So the Fed has already said we're pulling back, we're raising rates. So
yeah, I agree with you there. And then the last thing we talked about, or you highlighted, is the one kind of risk factor out there. And that's for me, it's the Fed creating or inducing a market accident, which they have done, right? They've historically been late or late. Yeah, they've historically been late and went too far. I think 2018 is an interesting example of that, right? Q4 of 2018, big impact in residential. I was in the game. I knew lots of flippers who, like the market seized up for like 60 days. Yeah. So the Fed can do it. And I think if the Fed, for me, Jonathan, the Fed's been very clear, stopping the taper. I think people knew that.
Yeah.
Starting interest rate rises. They were ready for that. What I think caught people off by surprise, and I don't know that we know what's coming, is they're going to start reducing their $8 and probably soon to be $9 trillion balance sheet, right? They're no longer going to be buyers of bonds. They're not going to sit on the sideline either. They are going to sell.
Yeah.
If there's not an appetite for that, the bond goes down and rates go up.
Yeah.
That has me somewhat nervous.
Yeah. I mean, well, listen, we've talked about this before. I really think the Fed blew it in 2018, in the sense that when Wall Street screamed and the real estate markets screamed, they lost their nerve and didn't continue interest rate hikes, which they, in my view, should have continued to take some air out of the bubble. The Fed has been unwilling to really have us suffer any pain, right? And and the fact of the matter is, we've been living on sugar water for a long time, and that you're going to have to get off the addiction to sugar water has got to end, and that withdrawal, we're going to have to suffer that sugar withdrawal. And frankly, in a couple of months, the market would readjust. It's not like, like the market always readjusts these things.
No, agreed.
There are some people who get, some people
get got.
They get got, right?
Yeah.
And it's so, and that's just life. But I think the Fed is like, the Fed has become like that indulgent parent that doesn't want to say no to any of its children. And and then when they start getting a little bit of backbone with the children, and the children scream, they're like, "Oh no, I'm sorry, don't have a tantrum. Here's the candy." Yeah,
here's the candy. Yeah.
And that's kind of what the Fed has become, unfortunately. So,
yeah, I totally agree.
It happens.
Yeah. So again, I think for me, I guess what I'm summarizing is keep looking at multifamily. I'd love to buy something bigger. Let's be very clear. I'd love to get. I've told myself I want to try to buy $2 million in good or great deals. If that comes in one deal, great. If that comes in houses, great. That's one I want to deploy this year, or try to make happen. So I'd love it to be a multifamily. We'll see. But yeah, any other closing thoughts? And let's make sure to highlight your group, because this was a post that you had in the group that really churned a lot of conversations. So let's make sure to highlight the group so people join.
Yeah, absolutely. I mean, it's called the Multifamily Investment Community. Come, swing by, just search for it on Facebook. Please, the first time you go, please do it on a computer if you can, because there are questions you need to answer. to get in, and I just reject everybody who doesn't answer the questions. But
Mhm.
but Facebook doesn't show the questions on phones. For
This
whatever.
is what it looks like, folks.
Yeah. So go there, multifamily investment community, and you can take part in the conversation, and just have some fun and learn some stuff. Maybe even, who knows?
Yeah, no, I go to it almost daily, just because you put out some thought provoking stuff, and you have, what is it, 11, 12,000 members? I mean, just the
Yeah,
amount of communication is amazing.
almost 12,000. Yeah.
Woo! Thanks, Jonathan.
Thank you.
Mhm.